Hello students, this week we're going to focus on Chapter 15, Price, the Only Revenue Generator. Some of the learning objectives for this chapter are the following. Understand the factors in the pricing framework. Explain the different pricing objectives organizations have to choose from. Understand the factors that affect a firm pricing decisions. Understand why companies must conduct research before setting prices in international markets. Learn how to calculate the break-even point. Understand introductory pricing strategies. Understand the different pricing approaches. Going forward, we are going to look at some of the pricing objectives. This section discusses the factors in the pricing framework and the different pricing objectives organizations have to choose from. You must have prices that are consistent with their products, promotions, and distribution strategies. The price, product, promotion, and placement of a good or service must convey a consistent message. Before setting up the price for an offering, a firm must determine its pricing objective, or what it wants to accomplish with its pricing. It must also estimate demand, determine costs, and analyze all factors affecting pricing decisions. The most common pricing objectives include earning a targeted return on investment, or ROI. The profit an organization hopes to make given the amount of assets or money it has tied up in a product. Number 2, maximizing profits. Set prices to increase revenues as much as possible relative to costs. Maximizing sales. Pricing products to generate as much revenue as possible, regardless of what it does to a firm's profits. Maximizing market share. Set prices allows capturing a larger share of the sales. Maintaining the status quo. Meet or equal competitors' prices. Going forward, we are going to look at the factors that affect a firm's pricing decisions. Understand why companies must conduct research before setting prices in international markets, and understand how to calculate the break-even point. 3 important factors are considered in the pricing framework, or when making pricing decisions. Will buyers perceive the product offers value? How many buyers are there? How sensitive are consumers to changes in price? Price elasticity is how sensitive buyers are to changes in the price of a good or service. If an offering is price elastic, then raising the price will cause buyers to purchase less of the offering. If the price is price inelastic, then raising the price will not affect the buyer's purchasing decision in the short term. However, companies do not have free rein to raise prices for offering with an inelastic demand. Eventually, customers may find alternative offerings rather than continue to purchase the product or service long term. A typical example is gasoline. When prices per gallon reached $5 in 2008, many people traded in their gas guzzlers for hybrids and alternative fuel vehicles. More than a year later, when automobiles remained top sellers, even after gasoline dropped to below $3 in 2009. Luxury goods are viewed as having an elastic demand because increases in price result in fewer sales or less demand. Necessities are viewed as having an unelastic demand, meaning sales will not decrease significantly with the increases in price. The line between luxury and necessity good can vary from buyer to buyer. For example, smokers keep purchasing cigarettes even after prices rise significantly, but most people would agree that cigarettes are not necessities. Because competitors want to establish and maintain loyal customers, they will often match their competitors' pricing. Some give discounts if lower prices are found elsewhere. The availability of close substitutes also offers a company's pricing decisions. So price elasticity is calculated in the following way. It is an equation where percentage change in quantity demanded is in the numerator, and in the denominator we have percentage change in price. Weak economies and high unemployment call for lower prices. In international markets, currency exchange rates affect pricing decisions. Pricing decisions are affected by federal and state regulations. Robinson-Patnaik limits channel pricing. Price fixing isn't illegal under all circumstances. Unfair trade laws protect smaller businesses. Bait and switch pricing is illegal in many states. The costs of the product include the amount spent on product development, testing, and packaging required have to be taken into account when a pricing decision is made. So do costs related to promotion and distribution. An offering stage in the product life cycle can affect its price. If a company has to open brick-and-mortar storefronts to distribute and sell the offering, this too will have to be built into the price the firm must charge for. The point where total costs equal total revenue is called the break-even point. Total costs include both fixed and variable costs. Fixed costs are the costs that must be paid regardless of the production or sales level. Variable costs are costs that change with the company's level of production and sales. The formula for calculating break-even point is total fixed costs over contribution per unit, or total fixed costs over unit price minus unit costs. So once again, fixed costs are those costs that the company must pay regardless of its level of production or level of sales. Examples include rent on a building, utilities, leasing fees on equipment, etc. Variable costs are costs directly associated with making the product and are expressed in terms of a percentage of the sales price. Examples include raw materials, labor, and commissions on units sold. Example in student text demonstrates calculation of the break-even point for DVDs. Going forward, we are going to examine introductory pricing strategies and different pricing approaches that businesses use. Some of the introductory pricing strategies are skimming price strategy, which is setting up a high initial price for a product aimed at consumers who are willing to pay a high price and buy products early. Over time, the price of the product goes down as competitors enter the market and more consumers are willing to purchase. Penetration pricing strategy is setting up a low initial price to get as much possible of the market. Everyday low price is a pricing strategy used by Walmart. Companies can choose among many ways to set their prices. There's a cost plus pricing or markup pricing approach, where a company uses the cost of the product and then adds a profit to determine a price. It's the most common pricing approach. Odd even pricing, where a company prices a product a few cents below the next dollar amount, or a few dollars below the next $100 or $1,000 value. Prestige pricing utilizes a higher price to give an offering a high quality image. Demand backward pricing starts with the price demanded by consumers and create offering at that price. Some more pricing approaches are leader pricing, sealed bid pricing, online auctions, forward auction, reverse auction, going rate, and price bundling. Going forward, we are going to examine price discrimination. Price discrimination is really charging different customers different prices for the same product. In some situations, mostly retail, price discrimination is legal. Price discrimination is used to get more people. So price discrimination is charging different customers different prices for the same product. In some situations, mostly retail, price discrimination is legal. Price discrimination is used to get more people to use the product. A company might lower its prices in order to get more customers to buy an offering when business is low. Let's look at price adjustments, pricing adjustments, businesses. So price adjustments is actually changing the listing prices. Quantity discount involves giving customers discounts for larger purchases. Pricing adjustments businesses, these are free on board origin, FOB, or free on board destination, FOB. Let's look at some price adjustments. Uniform delivery pricing. Buyers pay the same shipping charges regardless of where they're located. Reciprocal agreements, agreements in which merchants agree to promote each other to customers. Bounce back is a promotion in which a seller gives customers discount cards or coupons. Let's look at the conclusions for this chapter. We can say that both external and internal factors affect pricing decisions. Companies use many different pricing strategies and price adjustments. Price must generate enough revenue to cover costs in order for the product to be profitable. Cost plus pricing, odd-even pricing, prestige pricing, price bundling, sealed bid pricing, going rate pricing, and captive pricing are just a few of the strategies that companies use. Organizations must also decide what their policies are when it comes to making price adjustments or changing the listed prices for their products. Some companies use price adjustments as a short-term tactic to increase sales. This concludes our chapter on price, which is the only general revenue generator from the 4 P's. It's a very important chapter, and just to remind you, you need to know how to calculate the break-even analysis, and you need to be aware of the most common used pricing strategies. I hope you enjoyed the class, and I wish you luck with the rest of your study program.